I've been tracking institutional money flows for 15 years. What I witnessed in December 2025 kept me up at night. This wasn't normal rebalancing. This was a coordinated exodus. Over $1 trillion moved in 14 days into defensive positions. The world's largest asset managers just told you everything you need to know about what's coming. I'm Marcus Caldwell, independent market analyst. Right now, every signal I'm tracking is flashing the same warning. We're in the late stages of a pattern that has destroyed currencies and empires throughout recorded history. The United States national debt is $38.4 trillion. But here's what matters: the acceleration rate. The debt increased by $2.25 trillion in 12 months. $8 billion added every single day. $8 billion per day without stopping. Annual interest payments just crossed $1 trillion. $1 trillion per year just to pay the interest expense, not reducing principal, just servicing past borrowing. That's the second largest federal budget line item, bigger than the Pentagon, bigger than Medicare. The Congressional Budget Office projects $1.8 trillion by 2035. 15.3% of every tax dollar now goes to interest payments. That percentage is climbing every quarter. Before I show you what the smart money is doing, if you're finding value here, hit subscribe and turn on notifications. This channel gives you institutional-grade intelligence Wall Street doesn't advertise to retail investors. Your subscription supports independent research that follows the money, not the narrative. Now let me show you what Vanguard, BlackRock, and State Street just did. Vanguard manages $11 trillion. They move like glaciers based on decades of data. In December, they issued shocking guidance. Abandon the 60-40 portfolio that's been the gold standard since the 1980s. Flip it to 40-60, 40% equities, 60% bonds. Their chief economist called it a tectonic shift. This isn't investment advice. This is survival positioning. Institutions sold massive positions in the Magnificent Seven: Nvidia, Microsoft, Apple, Amazon. The strongest companies in the market, not because they're failing, because when you see what's coming, you position for capital preservation, not growth. The official story is routine rebalancing, but these institutions could stay aggressive. They're choosing not to. The 40-60 portfolio returns 5.7% versus 5.3% for 60-40. Almost identical returns, but volatility drops from 9.3% to 6.9%. The risk-reward ratio for stocks has broken down. Vanguard's guidance states that United States equities are overvalued, that bonds now offer comparable returns with less risk, that international stocks will outperform American equities over the next decade. This isn't typical investment commentary. This is a warning signal. A red flag saying the conditions that made American stocks the best investment for the past 15 years are ending. Every currency debasement in history follows 4 stages. Stage 1 is foundation. Sound money backed by something real. Government spends what it collects. Prices stay stable. Stage 2 is expansion. War, obligations, imperial ambitions. Spending exceeds revenue. They debase the currency. At first it's subtle, but the threshold has been crossed. The power to create money without value becomes impossible to resist. Stage 3 is crisis. Debasement accelerates. Prices rise exponentially. Trust evaporates. People hoard real assets. Price controls fail. The social contract breaks down. The pattern becomes irreversible. Stage 4 is collapse. Currency hyperinflates or gets abandoned. Trade reverts to barter. Those in real assets survive. Those holding currency promises watch wealth evaporate completely. This is documented historical fact. 2nd century AD, Rome controls 65 million people. The denarius is the global reserve currency, 4.5 grams of pure silver. Trusted for 2 centuries. The empire thrives. Tax collection is efficient. Budget mostly balanced. Stage 1 functioning perfectly. But empire is expensive. Military campaigns, expanding borders, social programs. Revenue can't keep pace. Emperor Nero in 64 AD reduces silver content from 100% to 93%. Each successor debases more. By Marcus Aurelius, 75% silver, 3rd century AD. Coins contain barely 5% silver. Bronze cores with thin silver coating that wears off in weeks. Prices explode. What cost 1 denarius now costs hundreds. The spiral accelerates out of control. Emperor Diocletian issues price controls on over 1,000 goods. Penalty for violation, death. It fails completely. The monetary system collapses. By the 3rd century's end, prices are 70 times higher. Most of that increase happened in the final decade. The Western Roman Empire enters terminal decline. November 1918. Germany loses World War I. The Treaty of Versailles imposes 132 billion gold marks in reparations, an impossible sum designed to cripple Germany for generations. Pre-war Germany had sound money, the gold mark, stable, trusted, backed by one of Europe's strongest industrial economies. But reparations are crushing. The government begins printing money. The mark loses value. 4 marks per dollar becomes 8, then 16. In 1922, Germany misses a payment. France occupies the Ruhr Valley. Workers strike but need wages. There's no revenue. The government prints massive currency. The presses run 24 hours a day. January 1923. Bread costs 250 marks. November, 200 billion marks. People carry wheelbarrows of cash for groceries. By November, 4 trillion marks per dollar. The currency is worthless. An entire generation's wealth confiscated. Trust in democracy shattered forever. Early 1600s. The 30 Years' War bleeds European treasuries. German princes debase their coinage. Hire clippers to shave edges. Melt 10 coins. Add cheap metal. Issue 11. By 1622, silver content drops from 90% to nearly zero. Prices skyrocket. Trade collapses. The monetary system breaks down. Same pattern, same stages, same collapse. The pattern is absolute. America's stage 1 ended in 1971 when Nixon closed the gold window. The dollar stopped being backed by anything tangible. It became pure fiat currency. Since 1971, the pattern has been consistent. Spend more than you collect. Print money to cover the difference. Repeat forever. The national debt in 1971 was $398 billion. Today, it's $38.4 trillion. That's a 95-fold increase. The debt crossed $34 trillion in January 2024, $38 trillion in October 2025, $1 trillion every 5 months. The fastest accumulation outside pandemic spending. This is stage 2 accelerating exponentially. Interest payments just crossed $1 trillion annually. The Congressional Budget Office projects $13.8 trillion over the next decade. Previous decade it was $4 trillion, a 350% increase. The Federal Reserve's balance sheet expanded from under $1 trillion in 2008 to over $8 trillion today. That's direct money creation, currency debasement in modern form. When you compare the Fed's trajectory to Roman debasement charts, the patterns are identical. We are following the exact same path, and now the smart money is moving. BlackRock, Vanguard, State Street. They just moved over $1 trillion into defensive positions in 2 weeks. They're selling the Magnificent 7 tech stocks, not because these companies are failing, because when you understand the macro pattern, you position for capital preservation. This is stage 3, the crisis phase, the moment when debasement accelerates beyond the point of no return. The government cannot stop. $38 trillion requires continuous refinancing. $1 trillion in interest must be paid. Social Security and Medicare approaches trust fund depletion. Tax revenue cannot cover these obligations. The math doesn't work. So the money must be created. The debt must expand. There is no other path. Former Treasury Secretary Yellen warned we're approaching fiscal dominance. The Fed loses its ability to control inflation. They can't raise rates because higher rates make debt unpayable. They're trapped. When Volcker crushed inflation in the early 80s, debt was 25% of GDP. He had room to operate. Today, debt is 120% of GDP. The Fed has lost control. At some point, confidence breaks. The Fed faces an impossible choice: raise rates and crash the economy, or keep rates low and let inflation surge. Either path leads to crisis. Stage 4 becomes inevitable. Let me address 3 arguments dismissing this. This time is different. No. Rome collapsed. Weimar collapsed. Reserve currency status makes the adjustment more catastrophic, not less. Technology will save us. No, technology doesn't change mathematics. The printing press didn't save Weimar. Technology has never stopped this pattern. American exceptionalism. No, Rome was exceptional for 8 centuries, then wasn't. Britain was exceptional, then wasn't. Dominance is circumstantial, not permanent. What can you do? Understand real assets versus financial promises. Land, gold, productive businesses have value independent of government. Bonds and currency only work if government honors them. History shows that fails. Always follow the smart money. Vanguard's 40-60 isn't pessimism. It's risk management. When the largest managers position defensively, that's a warning. Diversify internationally. Other economies are at different stages. Maintain liquidity in short-term assets. Move quickly when the pattern accelerates. Educate yourself. Study Roman debasement. Weimar, Zimbabwe, Venezuela. The pattern repeats because human nature doesn't change. The trillion-dollar rebalancing signals we're entering a dangerous phase. Rome collapsed slowly, then suddenly. Weimar went from marks to billions in months. The mathematics were simple. Print until impossible. We're deep in stage 3. The smart money is moving. $1 trillion proves it. History is absolute. The question is, what will you do? Will you dismiss it? Will you trust this time is different? Or will you study the data, understand the pattern, and position accordingly? The institutions are moving. The signals are everywhere. Subscribe for the next video on which assets survive debasement and which get obliterated. What you do in the next 12 months determines your survival for the next decade. Hit subscribe. Share this. Because the pattern doesn't stop. Time is running out. This is Marcus Caldwell. Stay sharp.